about the impulse strategy, and just wanted to go over it again. Don't lose faith. That's number one. You don't even know how many trades I lost in my first month. It just happened. Even starting the strategy just a month ago, because I started with you guys just a couple days before, I lost trades. Me and Gio lost trades. Me and Gio were on the chart, analyzing a chart, like, yeah, that's a good setup. Boom, stop loss hit. We're like, fuck. So it's normal that you have your losses. In trading, it's not about winning every trade. It's about cutting the losses short. So it's all about, if you have 3 losses, to have one win that evens out your score again. That's the magic about risk to reward. One sec, do I have it? I don't think I have it. Let me send it to me on Telegram. I'm gonna show you one thing before we jump in, because it's really important that we talk about it. Where is that screenshot? Because I had this discussion with somebody the other day, and he now thinks he's really good in trading, like, because he flipped, like, he did gamble a lot. And I told him, like, bro, your risk to, because he asked me something, like, bro, your risk to reward is shit. You can't say the one trade you do 1% risk and the next you do 5% risk, and because you want to make like 20 bands with a trade. So here's the magic. I can send it to you guys in the group chat later. I don't know if I've sent it already or not. So here's the magic why risk to reward matters so much. And that's why it doesn't matter if you lose a couple trades or have a bad week. So you see you have the percentage in win rate at the top. That shows you how many trades you have to win depending on your risk to reward. And this is the risk to reward. So you see, when you have a 1-to-1 risk to reward ratio, like, you need to be at least 60% to be profitable. Like 6 out of 10 trades need to hit. If you go down, you risk 1%, and to aim to get 2, so risk to reward of 1 to 2, you can only need to hit 4 out of 10 trades to be profitable. Then you're profitable. And then if you go down 1 to 3, well, if you hit 20% of your trades, you're break even. As soon as you go 30, you're in profit. So you know what I mean? Like 3 out of 10 trades, if you win 3 out of 10 trades with a 1 to 3, you're in profit. So that's the magic about risk to reward. So don't get demoralized if you don't have trades or anything. That's why we're doing it together. So let's just go over impulse quickly, like, just to break down. So what we do is, I trade on the 5-minute chart here, right? So that's just me, because 1 minute is sometimes too fast for me, and I like the market to be a little bit more structured. So here you decide the time frames, and then let's say we go with odd JPY. We look at this right now, we see it's a downwards trend and a downward strength. So number one, those 2 arrows need to point in the same direction. If they don't point in the same direction, and I'll show you something, we will probably see a pair or something where it's not matched up. Yeah, here, New Zealand dollar, Canadian dollar. Trend is going down, strength is up. So you don't even need to look at it, because it's not in the right place. So let's say we go with here. So then we see that the trend is downward, so we're looking for sells. The strength is 27. We want it at least to be 20 to 30 above, like a good strength in a direction, like that it's not like something 19, 15, because then, you might have to wait a little longer for a good opportunity. So right now, for example, odd JPY, the market been going down and had a big push down. So we first look at the big EMA, so the exponential moving average, that's that line here, that changes color with where the trend is going to. So before, it was an upwards trend, and we were looking for buy opportunities. So that's why it was blue. Now it's red, so now we're looking for sells. Second thing you check is the 2 moving averages. So the 1 and the 2, they have different like inputs. That's why they're different. But in the end, like, when you're looking for sells, the red needs to be above the blue. And when you're looking for buys, the blue needs to be above the red. So that's like the first things you check. You don't even need to look at the arrows. So now JPY is moving to a point where either the lines cross or the market is going to move and turn going down more. So next thing we do is check the gray zones. The gray zones technically are the Bollinger Bands. So if you need to look at them, there are plenty of videos on Josh Lee's and Brandon Boyd's Impulse Go Live where they just explain the Bollinger Bands. So they just basically mean the market can move to this extent and bounce off it. That's like the volatility. If you want to sell here, the market can at least go to this point. So you know kind of where to put your stop loss at if you want to play safe with it. So those are like the ones at the main window. That clear so far, or any questions?
Clear for now.
Okay, so then we look down. This is the stochastic. This is kind of like, stochastic is just the basic game of probabilities where this chart down here shows you if the market is oversold, that's when it's at the bottom. So too many people sold. So that's why it's an area where it's good to buy. When it's above the red, it's overbought. So that's the point where too many people already buy. The market kind of took out all of the potential that was in there and is turning around again. So if the market is above, like the line is above the red, we can aim for a sell, sorry. Then down here is the relative strength index. It basically shows something really similar. It's just divided at the 50% line. And then there's the blue zone above the 50 to the 60. And then there's a white zone above it. That just means it's above. And below 40, that's also trend showing you downwards momentum. So whenever the market is in the red zone or below the red zone, it's a really strong index that the market continues to go its way. When it's in the blue zone, it shows you the market is going up. So when we go down back here to where we had a big upwards trend, you see that the market stayed above or in the blue zone till it started to go down a little. So when we look for a sell right now, we want the market to be above the red line here and in the red zone down here. So basically, let's see if we find a live setup. If not, we're just going to take one from today. So this right here is not a setup. Just to clarify, even though we're above the stochastic and in the red zone, the overall trend is upward. So you don't want to trade against the trend because that's basically the banks pushing the market into one direction. So we don't have a setup over here. We might see a trend change when this turns red, but we wait for it. We don't anticipate. We look for probabilities and then just execute if everything's all right. Here, the strength at Euro USD is too low, so we skip it. We go to GBP AUD. Okay, so we technically missed a buy opportunity. Not so much. So maybe we get one, but the market needs to go lower so we can buy it back up. Let's go to GBP CAD. We just missed one. So here we technically just missed one because the market showed us it was overbought. Then we wait. If we go with the rule book, Brandon Boyd and Josh Lee tell us we wait for the first confirmation candle after the red. So the blue candle would indicate us that the market is going to that direction. So it confirms that push up, right? So here now the arrows can be misleading. We would just have to see and wait till maybe the next candle closes because the lines are super crossed right now. So it could be that the market is turning around again. Like here, everything was all right as well. We had the first push, but the market still continued to go sideways. So that means maybe the time is not right. There's not a lot of volume in the market. So I wouldn't join in any trade right now here.
Can I get a question about it?
Yes, sir.
Okay. When I put some of my trades, I saw that when the continuation candle, like the first blue one, already went up or down like in a minute or so, do you wait for it to close or do you like step in like after a minute, 2 minutes?
No, I wait for the candle to close.
But when it's closed, the next candle already pushes up in a second or push down in a second. It's like scary.
Well,
what do you do then?
Yes, that's true. So what you can do is just have your phone ready if you market execute and then just hit it right when it closes. or you wait for it to come near your price again, or wait for the next candle close.
Okay, clear.
Your risk management, if
Yeah.
you do 1-1-2,
Yeah.
it separates, right? Because your entry, what you calculate, is not
Yeah,
the same
you have
as
to,
what you see
yeah.
in the chart.
And also the broker has a different price than the chart as well. So my
And with the
broker,
spread,
yeah, and also the broker has a different price and a different spread, true. So yeah, it could be different, but you just type in the same amount of pips then. So let's say we entered, so here was a buy setup. It was down here, the blue crossed the stochastic, it was in blue zone. So we could have entered after this confirmation candle. Let's say we placed our stop loss at the gray zone. And this is our point. Let's say our broker had a different price. You still use this stop loss, and then you just have to calculate a couple pips on top. So rather go down with the lot size a little bit, then it's maybe not 1%, but you can then here in the chart move the entry point to where you actually entered. So then it's still this shows still the same risk to reward ratio. You know what I mean?
Not really, man.
not really. No.
So let's say we want to enter at, right now here it's 12261, but let's say we enter it at 175. If we still use the same stop loss and you just alter this thing a little bit and we still use the same take profit, then the ratio is the same. The real ratio, not the same, but the real ratio. Then it would just be 1.9 instead of 2.68.
So
But
you will take some of the
profit
pips
away.
from
Yeah, because
pips
if
from the
we
stop
enter
loss.
too late, for example, like that's the example here, then we lose some take profit because the stop loss would stay the same. Because this is the area you draw on the chart where the market might turn. Or if it breaks here, then it goes lower. You know what I mean?
I think so.
So it's not really then this, yeah, that's the thing when you trade on a low time frame. That is just the issue that you have when you trade on a low time frame. What, for example, people like Justin and others do when they trade is, well, the way we trade, you can't use a buy limit or sell limit, right? Because we wait for the push up. So you would have to use a buy stop, for example. So, or you do it differently and try to snipe it a little bit. So, for example, one of the German educators, he always anticipates, let's say we go back to JPY, let's say, oh no, that's a bad example. Let me see if we find something. Let me just, yeah, okay, good. So this one, no. So everything is losing strength here. Okay, so here, this is a good one. So strength is positive. So let's say we use the Fibonacci tool, for example, to show or anticipate where the market might go down to. So you analyze it like this, because let's say you want to wait for the market to come there, right? Now we would have to wait for the market to drop here to enter. So you could place a buy limit anywhere between the 50 and the 67. Yeah, 67. So then you could place a buy limit. Let's say we place it right in the middle. And then it's the exact price when the broker hits. Let's say we do our stop loss, yeah, below here. And our take profit, let's say we go for 1 to 2 or something. Then you wait for the market to come to your place, activate your trade, but then you could have drawdown. And it's not really the rules when you wait for the confirmation candle. When you trade on
Fibonacci.
Yeah, when you trade on such low time frames, you basically just market execute right when you add it. Because that's the point of time-based trading. Because if you do something like this, you could just look at the 15-minute chart and then just say, okay, yeah, the market is turning upwards now. So I could look at more different entry points. So we could either say we go and look that the market can fall from this whole big move down to here, or we're just going to look at this push up, or we're just going to look at this push up, or at this push up. In the end, it's just a different perspective that you look at the market at. But on a higher time frame, you could definitely use the buy limit better. But when you look on 1 minute, you don't even have time to tap in your stop loss. You know what I mean? You got to be quick execution and then just calculate it in your head, kind of. So that's why I always say, if you want to use the impulse, and I know Raul trades on 5 minutes, then we would just use 5 minutes. So here, for example, we could look for a sell again. And the market might reach this point, and then we could place a sell limit and just place it here. Stop loss to the gray area. And then our take profit, let's say we leave it like that. Then it's not a 1 to 2. Or we could say, we say the trade, we want to get a 1 to 2. Then now we could place a sell limit with the exact same prices, and then you're spot on with the chart. That's just the thing about fast trading, that you have to either have a fixed stop loss when you say you always risk 10 pips. So this is 7 pips. Let's say we want to risk 10 pips. Then you can calculate your lot size before. You know what I mean? Because then you can calculate your lot size before, and then it doesn't matter, because then it doesn't matter if you enter here or here. Oh no, that's the wrong. If you enter here or here, because your stop loss stays the same amount of pips away from your entry point. So let's say we want a 1 to 2. So 10 pips risk, 20 pips profit. It doesn't matter if you enter here or here. You're still the same risk, because it's only 10 pips. So that's something, it's more like finding out by trial and error what works best for you. And in the end, you can always calculate your lot size a little bit lower so that you risk less. It doesn't matter, because the risk to reward ratio it's still the same thing. If you risk $1 to make 2, or if you risk 50 cents to make $1, the ratio is still the same. So that's something you have to try out by trial and error, what works best for you. I know Raul only trades like gold, or a lot of gold. So for example, here, this was a confirmed sell. I wouldn't enter because the market is so close to the gray area, right? But I could say, if I want to enter somewhere, and I can look at the move down, and I could place my sell limit now and say, okay, I'm going to risk, let's say 20 pips here, right to the 100% of the whole move. Yeah, it's around about 20, and I want to make 40. Then I have the exact ratio. So that's the way you can look at it.
Is that something you take notice of when it's like
No, I just calculated here. You see my lot sizes are sometimes different. Like the last safe one is 1.56. Like I just type it in with my real price then, where I'm at.
Yep.
Right now with my broker, and I leave my stop loss where it is.
but when it retraces, how did like here in the Bollinger Band?
Yeah.
Is that a indication that it's not really safe to step in?
Not yet, because you see like it needs to move out of it a little bit
Okay.
before it continues to go down. So it always does a little push out of the gray zone before it continues to go down. You see every time like it is in here, it moves out of it and then continues to go lower. And this is for every pair. Like it doesn't matter. Like if we look at odd JPY, you could jump in here always, like technically, but there's always a retracement coming. So I would just wait for it to move out of it, because when you see it in the gray zone, it's not overbought. It's not with the stochastic at the right place.
Yes.
So here it moved to the other upper gray zone. That's fine, because it's overbought. but it always does a little move. And you see how tight it gets between the Bollinger Bands? That shows that there's not a lot of volatility in the market. There's not a lot of volume right now. So you have a tight space to trade in. You see once the market does a big push up, the zones move big out of like far from each other. So it's sometimes tough in those tight spaces to get a good entry point. You know what I mean? So it's just like a lot of practice and just watching like others do it, like Josh Lee, Brandon Boyd, or be on the trading call with Gio. Like I know I didn't have the time this week to trade, and right now, like just going through the first couple of things, like I don't even find a trade myself. But the best trade you take is no trade. Because if you sit in your on your laptop just because you want to set a trade, it's the worst thing you can do. Because you cannot go onto the market and force it to go your way. You know what I mean? Like if I want to trade, let's say we want to find a Bitcoin trend trade right now, but the market is not there, we can't force it. And that's a big error, like a lot of people do, that they jump on the chart and they want to set a trade. But sometimes you just got to wait and look at it an hour again. And the things I like to trade, like for example, US 30 or US 500, it works the same way. I would just look at the zones as if everything's right. So for example, I would have found a trade right here. Like this was the push up, this was the push down, and just go with the wave. But it's depending on the time of the day. Sometimes like I still need to figure out what's the best time for me to trade right now because of that work schedule. It is what it is. But the main thing you need to check is if your stochastic and your RSI are at the right point. And then it's just figuring out how tight is your stop loss. You can't place a stop loss just because you want it to be super tight so you have a good risk to reward. You always need to place it where it makes sense. So for example, here, just to not get stopped out, I would go with the gray zone here and aim for a 1 to 2. But I will check my phone now and then to, you know, maybe go out with it. If I said I want a 1 to 3, this could have scared you out of it, right? Because it popped up again, but it's safe with the stop loss. And if then you look at the chart, you see the market is still going the right way. Let me just move this away. So if we enter here, have our stop loss right here above the gray zone, it made a good profit down. It spiked back up, but it's still safe. So you can just let it run. So it's a matter of how far away is your stop loss. Because if you just want a tight stop loss just because you want to have a good risk to reward, that's the wrong way to place your stop loss then. So I would always look for, when I place a trade on here, we can do this for any chart right now and just look for a setup there was, or maybe see if there's a setup right now, but nothing's there right now. So let me see. So here we have a tight space. So let's say we enter right after this candle and we place our stop loss right above the gray zone. That's where it makes sense. That's why the gray zones are there, because it's the space the market can move. Because if it breaks out, you know, the trend could be changing. You never know if the market, you don't see what's happening afterwards. So you don't know if the market's going to continue to go up, because the trend can always change. That's the same way it happens over here then. You know, it moves up and then it moves down and it continues to stay down, but you never know when it breaks out to go down, even though this was a blue trend before, like an upwards trend before. So the thing is, like, you just need to adapt to the market. And if the market breaks through it and you lose your trade, it is what it is. You'll find a good trade next time. Like, I blew so many accounts in the past, but here we have a strength is not there. The strength turns around. This could be a good trade. So right now we could technically enter this trade, and I'm going to prepare my phone. So I'm going to type it in. So let's say we enter right at 9 to is 692, and we aim for a risk to reward of 1 to 2. And our stop loss just a little bit higher, just so it has some space. Let's see if it goes there. Don't know, but maybe. So we have 18 pips stop loss, Euro USD. Let's say type in 10K, 1%, Euro USD. And my stop loss, 962 is my entry. My stop loss is at 879. Calculate 0.53. So now I'm waiting for this candle close in 3 minutes. Hopefully the price is still there, or we just enter it. Trade 692. Yeah, my broker is showing me 680. So it's not even like my price on the broker is even worse. So if I calculate it new then and say 680, it's 1.5.
So you wait until this candle closed, and then you type the entry, and then you get into trade.
Yeah, so this candle close needs to confirm it. And then we can alter the entry point. So let's just wait for 2 minutes here. Because we want to wait for the confirmation candle, right? So I just want to refresh because of the arrows. So we have everything set and clear again. So my broker shows me this price right now. So my stop loss was wrong way. Doesn't matter. Stop loss is above, is here at 7.9. Let's leave it there. And my take profit was at 332. Was that right?
You have the wrong.
Yeah, but it's still the same concept. So we have 19 pips. Like, oh yeah, it shows the wrong way. So it's a 1.8 risk to reward ratio. And let's wait for the candle close. But let's say we do still at 1 to 2. 277. So we leave the trade 20 pips to make 40. And we enter whenever the candle closes. If it's just 0.5 lot size, maybe it's not 1%. You know what I mean? Like that's just what it is sometimes. Like you can't predict it on a short time frame like that always. 1 euro. Let's see if we're fast enough before the candle closes. Entry is at 80. And my broker even shows me 86 right now. And stop loss 3880. Calculate 0.52. Yeah, so we can just leave it at 0.5. It's all good. Even if my stop loss then stays at the same point, even if my entry point is changing right now. So whenever this candle closes, I'm entering the trade.
But what if the candle closes way below your entry point?
Then I maybe not enter the trade. Then it's gone. So boom, I entered the trade at 698. So we entered at 237. It's the same. Stop level is 879. And entry price was at 698. Well, we see where it goes. Now it's just a waiting game. We entered a trade, and now it's just a matter of time. But we risk 1% almost. Like if we type it in now correctly, so we said we have $10,000. We want to risk 1%. It shows us exactly how much growth we can get. But something is off with the. Oh yeah, we're risking 100 to make 234. No, it's just a waiting game. That's the thing. Like, there's so many different ways to win, how to enter a trade, but there's so many good videos on it. I can just advise you guys watch them because the way I do it maybe not work for you. The way Gio does it maybe doesn't work for you. The way Raul does it or Justin does it maybe doesn't work for you. So it's really about just doing it and finding out what works best for you. If you want to work with a fixed stop loss of 10, 15, 20 pips, you can always have the same risk pre-calculated. You just go from wherever you enter on the trade. So what I did is I altered my entry point and left my stop loss at the fixed point. If you have a fixed stop loss of, let's say, 15 pips or 20 pips right now, and you go for the same take profit, let's say, the way you enter just changes, but the distance to where your stop loss is doesn't. Like the distance from here to here is the same, but it's not the same point. Maybe you enter here, your stop loss is lower than mine. You know what I mean? The way I just did it is I alter my entry point. So my stop loss moves and my risk to reward changes kind of. I still adapt then my take profit to 1 to 2. But let's say we enter way lower. I keep my stop loss at that point because I think this is a point when the market breaks through here. It's going in a different direction. You can follow me?
A little bit.
So
Yes, I understand.
So let's say I enter way lower than on my broker than what it was on the chart here. Let's say I enter down here. My stop loss stays at that point. I'm not going to move this point. The only thing I move is this point, right? Where I enter the market. So I then can, because of take profit, I can alter however I want to. I can just adapt to it and say, you know what? Okay, then it's a bigger trade. You know what I mean? Doesn't matter if I'm gonna do this, I can, after that, move my take profit, so it's a better trade. It's just gonna be a longer trade. It's not gonna be a short trade probably, but that's just the way I trade, for example. Because I place my my stop loss based on market structure. So when I want to enter a buy trade, let's say somewhere here, I know this is my stop loss. When the market gonna go below it, it's gonna go down because it changes the market structure. So if I'm not gonna enter here because I was a little late and maybe enter here somewhere, I still have my stop loss down here. So you see the distance is bigger, but then I aim for a bigger take profit. And maybe my take profit is in the middle of a candle. You know what I mean? Let me show you an example on TradingView of like trades I did in the past, just to show you like some reference on, so you understand kind of where I'm coming from. Let's just close this. Yeah, you're not gonna understand much of the chart because it just looks different. So here, for example, we have a trade. I could have entered down here. I entered later. Or I could have entered somewhere here. Let me change the time frame to 15 minutes, so it's maybe a little bit more candles there to see. So, yeah. Let's say I entered the trade up here. My stop loss stays down here. Then I would just move my profit goal up. So I stay to the same risk to reward ratio. For me, what matters is this number. It doesn't matter if I enter here. On this drawdown, my stop loss would still be down here because that's the point of reference. If it breaks this low, it's going down.
But if you keep setting your TP higher, it's a bigger chance it isn't going to hit the TP, right? Or
Exactly, it's going to be a longer trade.
so it's
yeah.
more risky.
Yeah, kind of.
Mm.
But that's why I'm saying the time frame matters. On the 15-minute chart, yeah, you would have gotten a heartache if I had entered here. My stop loss is down here because it went up, almost take profit hit, then went down to in drawdown to then go up, almost take profit hit, and then it went down a little bit again and then take profit hit. So the time span was from Friday 7:30 in the morning till all the way till this candle broke it till Tuesday at 8:15. So you just, if you do that and give it a little bigger stop loss and bigger take profit, your trade just gonna take longer time to either hit your stop loss or hit your take profit. So when you do really short and close take profits, the risk you have is that the trade is not even going your way yet. Because it still needs to go, let's say we're looking for a sell, it needs to go higher before it goes lower. But if your stop loss is right here above here, you can get stopped out easily. Let's see if we find an example for that. So let's see. This is all, yeah, the line was blue. Doesn't make sense over here. Let's see for sell buy opportunities. So sometimes you have those kind of things where you enter a trade and then your stop loss is maybe too tight. Yeah, this is an example. So let's say you go in here. This is the trade. We like right just a little bit below the stochastic. You enter this trade right here, and you think your stop loss below the last candle is enough. So you enter right here. Boom, stop loss. This candle stopped you out. You know what I mean? So you need to place your stop loss accordingly. So for the rule book, you can place it down to the gray area and then you would have been fine. But some people, like we did in the beginning, me and Gio, just below the last candle, and we had this a couple of times. We got stopped out really fast afterwards because the market was not there to go up yet. So that's something you have to figure out down the road. Like, where do you place the stop loss? There's no golden rule for it. I rather have a little bit more stop loss and give the trade a little bit more time to go up and time to breathe than to have short. Justin, for example, he trades with 10 pips stop loss, 10 pips take profit. I don't know if you still trade like that, but I know the strategy the German educator explained, it was a 1-to-1 risk to reward ratio. But he has 10 pips take profit, 10 pips stop loss. So he goes into the trade and says, I do 10 pips down here, so 100 ticks, that's 10 pips. And he does 10 pips to the upside. But he knows then, you know, I'm safe. You can do 10 pips and 20 pips take profit. Maybe your trade needs a longer time then. Here it was good, but on other points, maybe it takes some time before it hits it. It's just a matter of, you got to figure it out a little bit. It's tough to really explain those things with profits and stop loss hits. What you got to do is look at your trades, write down what was right when you entered the trade. Why did you enter the trade? And if your rules were in check, so for this trade, we can write down, so the EMA is red, the red MA is above the blue one. We were overbought. We were in the red zone on the stochastic. The market broke below the red line on the stochastic and is in the red zone at the RSI. Those were the things I would write down for this trade right now. Placed my stop loss above the red EMA in the gray, in the gray zone. And now we wait. If the market's going up, we can analyze why. And then you can reflect on why did the trade did not go your way. If you did everything the rule book says, you did nothing wrong. This was checked, like the first rule was checked. The strength wasn't there. So that's the only point. The strength wasn't there here. We just entered this trade just to have an example. It's on a demo account anyway, so it doesn't matter. It's about, you know, executing it, doing it. Strength wasn't there yet, so that's one rule off. Stochastic was there, red above blue, and in the red zone. So we had 1, 2, 3, 4, 5 rules, and 4 out of 5 rules were okay. So if this trade hits stop loss, then we know because the one rule was off, that's why it hit the stop loss. And that way you can understand what you did wrong. Like if this trade goes stop loss, I know exactly what I did wrong. Didn't check the strength there good enough because it was not at 20. Maybe it goes up and turns around. God knows. That's the thing. Like if your rules are okay, like if you are with your rules, then you did nothing wrong. Then it's just the market not going in your favor. Is that clear so far, or any questions?
Clear so far.
Yeah, this trade right now is in drawdown. It is what it is. So I gotta hop off in another call here in a couple minutes. So if you need anything, let me know. And thank you for jumping in. I'm gonna stop the recording.